Don Luskin, let me go to you. What will this mean to stocks? Because, and let me just focus this a little bit, I've been worried about tax selling in the last few weeks of the end of the year with no deal. Now, I guess my question is, will there be stock market buying as a result of this?
Yeah, I think, look, let's quote the great Deng Xiaoping, who said, "To get rich is glorious." What's important about this development is not a particular agreement reached on a particular day in Washington, but a change that has been brewing all year, where the American public has decided, after 2 years of believing that to get rich is inglorious, that to get rich causes bubbles and banking crises, that once again, to get rich is glorious. Because remember, Larry, what made this breakthrough possible is not just divided government, it's the American people sending messages starting this summer that resulted in Democrats, not Republicans, Democrats turning against letting these tax cuts expire on the grounds that we cannot dare to raise taxes for anybody in the recession. That is Democrats conceding that trickle-down economics works, that wealth creation is the secret to prosperity for everybody, rich and poor. And so whatever the stock market does tomorrow, I don't care. This is a gigantic turning point in the American culture where after a 2-year experiment with New Deal Part 2, we've turned our back on that and said once again in this country, to get rich is glorious.
All right, to get rich is glorious, but what's the economic impact going to be for 2011?
It's going to be all to the good, and your previous guest makes a good point about interest rates, but let's not forget, rising interest rates, if they happen for the wrong reason, could be a real retardant to growth. So for instance, if there was a sudden loss of confidence in the U.S. Treasury, the U.S. dollar, and interest rates skyrocketed higher, yes, that would be a problem. But interest rates embody growth expectations. So the very best thing we could see now would be to see interest rates go up a little bit as the result of improving confidence. I think that for next year, 3 is the new 2. We're going to have real GDP growth in the high 3s instead of the high 2s. We're going to have 10-year Treasury yields in the 3s instead of the 2s. And it's all good. Don't worry about it. It's all good.
Will we create jobs? And in particular, I'm looking at this 100% cash write-offs for business investment. Now, I guess it's only 1 year. Maybe it's going to be 2 years. I'm not sure. But jobs have been the problem, Don. It's been a jobless recovery, basically. Do you think this package will have enough of David Kelly's confidence, okay, Jeff Matthews' optimism, and I guess yours too? Will we get some jobs action out of this?
Yeah, I think we will. So this takes away uncertainty. This takes away disincentives to create jobs, and that's all to the good. On the other hand, extending the unemployment benefits from their current 99 weeks another 13 months is an incentive for people out of work to stay out of work, to keep collecting those benefits and enjoying all their tax-free leisure. So it cuts both ways. But I really think the important key here is the elimination of uncertainty and the signal that America is capital friendly again. It is going to be a better year next year for stocks, for jobs, for the economy, for everything.
Jeff Luskin, lightning fast, lightning round. Your bet, you're going to write a good newsletter tonight and send it out. What's your favorite investment play going to be with this new news?
I think maybe this is when you start moving off metals as an inflation play into energy as a combined inflation recovery play.
Energy. You like the energy play? Is that what I just heard?
I do.
All right. And what about the Europe play? Real fast. Would an imploding Europe stop this, or are you okay on Europe? We haven't gotten that because of the time considerations. Real fast, Don, your quick take on Europe.
Look, I respect that it's a risk, but I think it's going to get taken care of. It's in Germany's and France's interest not to let their own banking systems explode. So don't worry, they got this one covered.
All right.